no sugarcoating. Last night we heard from Red Hat, the leading purveyor of open source software. It's become a major player in the cloud, as well as being a longtime Cramer fave. And the company cut its guidance, which was a bit of a shocker. Now, I've been telling you that this stock tends to sell off even after good quarters, but today it plummeted $23 or 14%. Ouch. So what went wrong? Red Hat actually reported a nice top and bottom line beat with solid 20% revenue growth, but management's guidance for both the next quarter and the full year was a little bit disappointing for the analysts, thanks to a slowdown in their middleware business and some tough competition. That hurts. When a company with a high-flying stock disappoints, it's going to get obliterated. Remember, though, Red Hat's been on fire lately, and even with today's shellacking, it's still up 18.5% year-to-date, and they're pretty much sticking by what they said they could do, but this next quarter will be tough. How worried should we be? Look, we have to be concerned after this drop, but this is a company that's done well for investors over many years. And we may have seen this movie before, and it ended happily. Back in December of 2016, Red Hat disappointed, and stock fell from $79 to $68. But then we had CEO Jim Whitehurst on the show, and he made a compelling case for the long-term story here. Since then, the stock has more than doubled. So did Red Hat merely hit a speed bump here and will use a $1 billion buyback announced last night to buy stock with both hands? Or has the company crashed headfirst into a retaining wall while traveling at 100 miles per hour? Let's dig deeper with Jim Whitehurst. He's the president and CEO of Red Hat to get some context on what's happening here. Mr. Whitehurst, welcome back to Mad Money.
Hi, Jim. It's great to be back.
Jim, you deserve this because you've been on the show many times. If you could do your conference call over, would there be some things you would change?
You know, frankly, not really. I mean, if I could change anything, I would encourage investors to look long term. You know, we've told investors time and time again over the last 10 years that billings can be volatile. The last time I was on, if you recall, we had kind of light billings quarter and the stock dropped a lot then, and then obviously it's doubled since then. So, you know, we don't manage the billings because they're not a great indicator of the health of the company. And so because analysts look at billings, that creates some volatility, and we just learned to live with that.
Now, the quarter itself was very strong. It was the forecast. And so I found myself thinking, what could happen during a quarter that made it so that when you got to the forecast, it was markedly different from what people thought you might be able to get?
Yeah, you know, I think what happened, and we spent a lot of time speaking with analysts afterwards as well, you know, we delivered exactly what we said we would deliver. And in the follow-ups with analysts, we went through that fact. And, you know, even after our analyst day that we did a couple months ago, the stock ran up quite a bit. And I think there was this sense that even though we had said this was what we're going to perform like, I think there was a sense that we were going to kind of beat and raise the way we did last year. And, you know, we had a really great year last year, which creates tough comps. And so we said what we would do. We delivered that. We reaffirmed guidance for the year other than pulling down for currency. But I think there was a sense that we were going to really blow it out. And frankly, we just delivered what we said we'd deliver.
It's funny
and I think that created a bit of disappointment.
I was speaking to one of my tech friends who said, listen, Jim, they didn't beat and raise. They're a beat and raise company. They didn't beat and raise. But I want to go to a Jefferies report because I want to be sure these numbers are correct. They talked about how new sub annual contract value declined by nearly 30% by our calculation, due primarily to what management believes is temporary softness. But is that the right calculation?
Yeah, that's a kind of an odd calculation that people are looking at the data and trying to segment pieces out. What's driven, I think, some odd results is that, and we've said this, 2 years ago we started saying we were focused on getting large 3-year deals with our customers. Right. So we kind of locked them up for their core product, and then we'd work on selling them net new business. Well, we started doing that 2 years ago, so we've had 2 years where we tried to lock up customers in multi-year deals. So by the time we get to year 3, and we've told the street this, our renewal base is quite a bit lower. And so with the lower renewal base of the big, you know, Red Hat Linux deals, you know, we're out there selling new business either to those customers or to others. And new deals, you know, net new always start off smaller. So yeah, the average deal size, it can be a bit smaller, but recognize our deals over $1 million grew 65% year over year. So even though some of those huge deals, you know, that were multi-year deals didn't happen because we've already renewed them, we still grew our $1 million deals by 65% year over year.
All right, so let's go over the The competitive space. I know that Amazon's making some changes that would make it so that if someone wants to use Amazon Web Services, it might freeze the market a little bit. Try to put Red Hat versus that. Are you noticing a competitive change there? And also, you talked about Oracle and IBM on another part of your business, saying that they are being very competitive. Are these new dynamics that we must be concerned of more than just a short term?
Well, I think the dynamic that we talked about, which is a long term, is around our traditional middleware. So Red Hat has two components of middleware, which is kind of the glue that developers use to glue applications together. There's the old world Java piece of that, and then there's a whole lot of net new frameworks. And we play in both spaces. In that old world where we've traditionally taken share from IBM and Oracle,
right.
There's not a lot happening there. And so what's happening is IBM and Oracle have just reduced prices to keep from eroding that business. And the vast majority of our effort is in the new pieces of middleware, and we're seeing great traction there. But there is this little bit of a decline in the growth rate of the old stuff as the new stuff is accelerating, and that together has caused our middleware growth to moderate. Now, that we expected that. We talked at Analyst Day a couple months ago that we expected that to happen, and we're seeing great traction with the new stuff, which is really driving a lot of incremental growth for us.
Look, I'm loath to ever contradict you because you have been so great, and the amount of money that your company has made for our viewers is extraordinary. But when I went over the May analyst meeting, I did sense that there had been a bit of there was buoyancy there that I didn't get on this conference call. And one of them was, let me just point out the type of thing I felt. Eric Shander at one point, he was saying, he was talking to somebody, he goes, what we've been saying is we're pretty comfortable that our each AL, the enterprise, is going to be growing in double digits. And we've been saying low teens, and certainly 11% is a number we're happy with. Now, Jim, I was not happy with that. You were happy with it, and that surprised me. I would have said, and we wish to do better.
Well, look, it's one quarter, and again, when we know when these big renewals are happening, I certainly think that we believe that we'll see better numbers through the course of this year with that. So in this quarter, I think that's kind of where we were expecting that to end up. I certainly think as we look forward and we know when and how the larger renewals and growth around those will happen, we'll certainly be looking to continue to drive that growth rate higher. So again, this is, when we talked about, we provided guidance, we were talking about for the year. And so in quarters, and Q1's our seasonally lowest quarter versus for the year where we reaffirmed our guidance. I think there may be a little bit of a disconnect there between what analysts were looking for in a quarter versus what we were talking about for the year.
And could it be perhaps related to some of the large telco relationships? You said there weren't many this quarter, but you did feel very confident, solid relationships. I thought that maybe that was something that could be shifted later to the year.
Yeah, so what's happened with those is we've made a lot of traction as telcos look to roll out 5G, and we're in the early days of those. And those are large handfuls of telcos. It's not hundreds. And we have great relationships, and we've signed up most of the large telcos around the world. Those just happen to have mainly fallen in Q3 and Q4. So we're doing a lot of work. I've had multiple conversations with some of the large telcos this past quarter, but it's all about implementations for things that we did in, last year. And so we certainly expect those to renew and continue to grow in Q3 and Q4. But again, those just aren't a Q1 set of opportunities for us.
Well, excellent, Jim. I'm so glad you came on. This stock was down, and it's been up very, very big. We should never forget that. I want to thank you so much, Jim Whitehurst, President and CEO of Red Hat. It has been a huge winner. There was a hiccup. Let's see what happens. Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.